Morning, everybody. Thank you for joining us this morning for the now monthly housing market update with the one and only David Arbit. My name is Ann Gadel, and I am the marketing specialist here at MAR. And before I hand it over to David, just a couple of reminders. This webinar is being recorded, and it will be available on our website later today. Also, if you have any questions throughout the presentation, feel free to raise your virtual hand, use the chat or the Q&A features. And with that, I will pass it off.
Thank you, Ann. Thank you so much. Ann is just doing a tremendous job, and we'd be almost lost without her. So thanks, Ann. Well, first things first, I want to share my screen. That would be a big help. So let's go ahead and start with that. And yeah, I think first things first, I want to give a thank you to our sponsors, without whom we would not be able to bring all the content that you guys enjoy and appreciate and help you do your business. Yeah, we couldn't do that without them. So we want to say thank you to Bell Bank Mortgage, as well as our friends at North Star MLS. A big shout out to RCU Royal Credit Union, as well as our friends at Supra, one of the most forward-thinking key fob providers in the industry. Want to also just take a moment to mention we've really put a lot of time and energy into creating this rebuilding community page. So I think it's really worth checking out. There's a lot of great resources on how to get involved and do really positive work out in our community. We also still have our COVID-19 resource page. There's still really excellent resources there for you guys, so we encourage you to check that out as well. Okay, getting down to why we are here today. So first things first, we're going to chat about the market. We're going to start with showings. We're going to talk buyer and seller activity. Of course, we're going to break things down by price range, because a $180,000 property does not behave the same way as a $2.5 million property. So we're going to talk price ranges. And then, we've got some updates on our June numbers, obviously, with June data out. I want to take a look at some of these longer term trends with you guys, if you'll permit me. We're going to talk market reports and InfoSparks if we have time, and maybe I'll pepper in some reflections and musings on the economy and the recovery. So brace yourselves. Data analysis is coming. So, we've had some headline risk lately, second wave, cases increasing, all these things. But we also have what I might call a headline reward. So there's headline risk, then there's headline reward. Existing home sales jump. U.S. housing set to ride out the pandemic storm. 5 reasons why the housing market has recovered from COVID. U.S. sales of existing homes jumped 20%. See, guys, we've got CNBC and Fox. We're balanced. America's housing market is so far unfazed by recession. It's official. The U.S. won't see a housing bubble crash anytime soon. And lastly, U.S. luxury housing market saw prices and demand grow in May. So definitely some positive headlines. I think people are, as we read through and sort of sift through some of the June numbers, people are feeling a little bit more optimistic. How about on the finance side, on the mortgage side? Mortgage rates reach record lows again. Mortgage applications for home purchases climbed by a third, up 33%. Again, as rates hit their all-time record low. Mortgage rates just hit a new low again from our friends at the Wash Post. Here's Forbes. Mortgage interest rates fall to their lowest rate ever recorded. Again. Thank you, Amy. So let's take a look at this. 30-year fixed rate mortgages. What's happening here, you guys? Well, we just kind of saw. We have posted a new low for the 30-year. Something that's interesting that I like going back to is we are ahead of 2006 prices, by a decent amount. And yet payments still aren't back to 2006 levels despite those more expensive homes. Well, what's driving that? The last time prices were nearly this high, look at this. We were financing those purchases at 6.75% roughly. Now we're actually below 3%. Let's see. 2.98%, 2/100ths below 3% on the 30-year fix. It's really an incredible thing. I don't think any economist would have predicted that we'd be below 3% here in 2020. But then again, nobody predicted a pandemic. Those things are notoriously difficult to forecast. So below 3%, really a remarkable figure. And by the way, this is a huge motivator, a huge incentive for buyers. So buyers, especially first-time buyers, especially those shopping in the affordable ranges, to the extent you can find something, these interest rates really are remarkably attractive. So these attractive rates have, of course, kicked off this wave of refinance activity. You guys can see that wave of refis. So forget refis. This is the Mortgage Bankers Association. This is actual purchase applications. So not refinancing, but initial purchase applications, pre-approval letters, all that fun stuff. You guys can see the pullback, when COVID hit. We can really see the pullback in this 4-week moving average, but we can also see that it snapped back to trend pretty quickly. So this does look like a V shape, in fact, a pretty tight V, but that doesn't necessarily hold with job growth, wage growth, other things. So even though this is a V, it doesn't mean the whole recovery is going to be V-shaped. All right, the market. So, as we see it, there are 3 overarching trends. Think of these as 3 macro, high-level trends. First, buyer activity is remarkably strong. We just saw that. We saw the headlines. We're going to jump into our numbers locally for our Twin Cities Metro. And even though we like to think we're above average, and I guess we are in a lot of ways, we've had the very similar gains to other regions and the nation as a whole. So listings under contract, what we call pending sales, so signed purchase agreements, actually reached their highest June level for any June since 2004. So last month, folks, made a 16-year high for pending sales. Pretty interesting. Seller activity is still weak. Sellers are still listing fewer properties than they did last year. So if we don't have sellers fueling all this buyer activity or replenishing the listings so buyers can write offers on them, it's going to be tough to sustain some of the momentum that we're seeing. Inventory by far is the biggest factor holding back sales. And might I add, it's also the biggest factor that's frustrating buyers, because we keep hearing still buyers who write 3, 4, 5 offers on a home, were beat out in multiple offers. So there's still this competitive bidding type of landscape out there. Again, the longer term trend, active listings, homes for sale, have declined 2/3, 66% since 2010, even though sales and population levels have both increased. So again, very much tight inventory, really putting pressure on buyers, also pressuring prices higher. Really weak supply, really strong demand. So we kind of know what happens when we have those 2 factors combined. So we're kind of going to do a part A. We're going to look at daily, weekly, and some of the short-term trends, but then we're going to try to do monthly and longer-term trends. So I'm going to kind of break things up a little bit. Okay, let's roll into showings. This is a daily showing activity. But each point on this curve actually represents a week. So we have this rolling weekly average that kind of smooths out or silences some of that noise or the variability in this data, in this metric. So a couple interesting notes, and I don't want to spend a ton of time here, but just a few interesting thoughts. First of all, 2020 in blue, last year, 2019 in gray. First things first, we were trending pretty well. Looks like showings were doing very well ahead of last year. I like to mention that last year we saw a lot of snow and a lot of melt very quickly. A lot of people had water in their basements who would have otherwise listed. So maybe this isn't a perfect apples to apples comparison. But once that weather factor sort of melted, see what I did there, or evaporated, we kind of saw things come back for 2019 here in gray. Of course, enter COVID mid-March, we can really see the impact on showings. However, we've gotten all the way back and then some. So you guys will notice this 2020 trend line in blue is trending above last year's levels, above 2019 levels. So one of the interesting things, if any mathematicians out there, one of the interesting things to think about is this area between these two curves that we may have lost, can we make up some of that? Can we make up, some of that? This is a little bit ahead. This is a little bit ahead. Can we overcome some of these losses? I don't know for sure. Nobody does. But what's nice is we are trending above last year's levels, even though we were trending below, in the months immediately following the outbreak of COVID. All right, overall showing activity by price point. So this one's pretty interesting. We go all the way from under 200,000 to over 1 million, and you guys can see kind of everything in between. So this is for this most recent week last year in blue versus the most recent week this year in gray. I would say the big takeaway here, we really see a decline in affordable, just because there isn't a lot of product on which to schedule showings. And we can see a pretty large gain here in this 250 up to 300 range. Also a really nice gain here for properties listed between 300,000 and 400,000. Another way to think about showing activity, not just the numbers like we saw on the previous slide, but also the market share. Think about this as market share, the share of overall showing activity in each price range. Again, the big takeaway here, I would say, for the same period last year, 1 in 3, I guess a little shy of 1 in 3, 30% of showings were scheduled on homes priced under 200,000. Most recently, that was 20%. So 30% down to about 20%. That's a pretty significant change. Flat to down slightly for 2 to 250, and a nice gain here again in 250 up to 300, and gains elsewhere as well. So how about the change? We looked at the figures, the raw numbers. We looked at the market share. How about the year over year change? No surprise, 19% decline in showings on homes under 200,000, all the way up to a pretty significant 2/3 gain, nearly a 66% gain on homes priced between 600 and 800,000. And you guys can kind of see how things vary in between. Overall, 17% increase in showings from the same week last year. So help me think about this, you guys. We like to think about the life cycle of a listing. If you're trying to predict what might happen with, well, I should even have prices here. If you want to see what's going to happen with prices, we'll look at the deals closed. How many deals are we closing versus how much supply do we have? Are those closings skewing toward luxury product, higher priced product, maybe new construction in the Blaines and Lakevilles and Woodburys and Minnetrista and all those exciting places? So if you want to see what's going to happen with closed sales next month, we'll look at pending sales or signed contracts this month. Or look at showings last month, or look at pre-approval letters from the month prior. So there is this life cycle of a listing. Before something's closed, it has to have an offer, and 99% of the time it has to have a showing, and 99% of the time those buyers need pre-approval letters. Similarly with sellers, there aren't quite as many steps, but on the supply side, so this is kind of the demand side. On the supply side, before you're active, you have to be newly listed. So if you want to see what's going to happen with inventory or active listings, later on this year, it's good to keep an eye on new listings, in the coming months. All right, one of my favorites. I hope I don't say that about all of my charts, but they're all pretty good, to be fair. So new listings in the metro, again, using our rolling weekly average. So this time we've actually thrown in the previous 3 years. So we've got 2017, 18, 19, and 2020 in black here, along with different shades of blue here. We can see, sellers were looking pretty good pre-COVID, right? Kind of maybe they were in second place here, looks like second place here, first place here of the last 4 years. Enter COVID, and we can kind of see the impact. Things came back a little bit, but we've really flatlined since then. And notice how we are trending below these prior 3 years. So seller activity, still a gap, notably below past years. How about on the demand side, pending sales? Again, looking pretty strong this year until COVID hit, and then we can kind of see the impact. The timing is really interesting, you guys. If you look at this, I think it was March 14th. Was that the school closure or the stay-at-home order? Don't quote me on that. I'd have to look that up. But March 15th, maybe 14th, 15th, 16th, that's when we really saw that high in. And then just about on cue, April 15th, 16th, that's when we kind of saw our bottom in. So pretty interesting, almost exactly a month to the day before we kind of return to our uptrend. So here, you guys, on the demand side, on the pending sales side, check this out. Notably above the previous 3 years. So this tells us that buyer activity is really quite strong. And even here, you guys, so this is the 4th of July dip, of course. Activity always slows when everyone's up at the cabin or wherever people go. Well, they're not flying anywhere or probably eating out many places. So whatever it is people do, playing games in their basements, whatever they do these days. But look, 2020 here in this darkest color is trending above all previous years. At the risk of getting a little granular and a little geeky, I will just zoom in a little bit and really show you guys that trend of this year truly outperforming past years. A little bit of a slowdown over the July 4th holiday, and we're still trending above these prior 3 years. So demand really is strong. It's really robust, and we can see that in the data. Okay, I didn't check to see if my good friend Pat Paulson is on the line. Let's just see. Looks like he didn't make it, but at least not yet. But Pat Paulson and I, we talk about this one quite a bit. This is the ratio of pending sales to new listings. So basically a value of 90% tells us that there were 90 pending sales for every 100 new listings. So think of this simply as a ratio between demand and supply. Well, check this out. When this indicator is over 100, when this ratio is over 100, we've got more sales, we've got more buyers than sellers, right? And that's kind of an interesting place to be, right? So we can see now, I guess 2019 technically, hit almost 120, even though this year we only hit, I put only in quotes, we only hit about 110. But notice after the holiday, we're trending well above, significantly above past years. At 90%, well, we just saw what that means. So buyer activity is really overwhelming or outpacing sellers or new listing activity. So pretty interesting data here. I know it's a little messy. There's a lot of noise in this data, but just understand, you can kind of see the trend and what that's trying to tell us. All right, let's talk a little bit about year over year weekly change. So this is from our most recent week this year compared to the same week last year, or at least as close to the same week as we can get. A change in new listings, so seller activity. Sellers listed 50% less product between 120 and 150 than they did the same week last year. No surprise, guys, there just isn't a lot of product at these price points. So no surprise that sellers just aren't listing them. And by the way, if you own a $150,000 condo, I guess depending on age and family situation and circumstances and finances, you may not be so willing to give it up. Excuse me. Okay, so down 5%. So that's pretty different than 50%. Seller activity down just 5% between $250,000 and $350,000. We actually had an 8% gain for listings over $1 million. Interesting. On the buy side, on the pending sales side, looks like those sellers aren't that far off because buyer activity was up notably in that $1 million+ segment. I really see a tale of two markets here, you guys. I see this market and then I see this market. And sure enough, our cutoff is, well, I suppose our median sales price is about $305,000 now. So technically our cutoff would kind of be within this price point. But you guys can see our luxury ranges, a lot of buyer activity above $500,000, at least big gains. Of course, the bulk of the activity is in these ranges, but we see the biggest gains here. Well, guess what, guys? These folks tend to be able to work from home and weren't as impacted by job losses, income losses, as folks who would be shopping in these ranges. So I think this has a lot to do with what's happened regarding in relation to COVID. How about year over year monthly change? So sometimes a week can be volatile. You're just looking at a week. Monthly numbers tend to be a little bit more stable, a little bit more meaning from them. Change in new listings for June of this year compared to June of last year. So, first things first, I see losses across the board minus this $750,000 up to $1 million segment. where we had a 12% gain in seller activity. Here again, about a 50% decline in our most affordable range. But let's focus here for a second. We didn't see huge declines. I guess I should say, just forget this one for a second. These three, I guess, are the best of a bad bunch, as we've been saying. So minus 5% or 3%, not a huge change in some of these maybe mid-market or maybe move-up segments, if you will. 25% decline in seller activity over a million in June, even though we saw an increase for that week. And also keep in mind, you guys, if we had 10 new listings over a million, last June, and then this month we have 15, well, that's only 5 more, but that's a 50% gain from just those 5. So just keep in mind small sample size. That's what we call small sample size. Always have more volatility in smaller markets, just because there just isn't as much data. It's not as smooth. So looking at pending sales for June of this year versus June of last year, pretty similar trend, guys. Kind of a tale of two markets here. We see declines in buyer activity under $250,000, right? Under 250. I guess we see varying degrees of declines, and then increases pretty much 250 on up. Overall, that was just shy of an 8% gain in signed contracts, even though we saw a 37% gain in our $750,000 up to $1 million submarket. So this is exactly the two that we just saw, but I've co-plotted them. I've plotted them together. I kind of love this one just because it really kind of tells the story. What's happening with changes in sales relative to changes in listings. So here's an interesting one. We had a 7% gain in sales, right? As we just saw, there's that 6.7 versus that 25% decline in new listings. So an interesting juxtaposition here, if you will. Same with here, right? A lot of buyer activity in blue, a 13.5% gain in buyer activity, but a 7.5% loss in seller activity. So pretty interesting here. When you have demand outpacing supply, you tend to have price pressure. You tend to see a stronger appreciation. I don't know why I find this fascinating, but I do. All right, let's talk about some of these long-term trends. We're kind of getting into our part B, some of our longer-term trends here. So June new listings, we saw a 12% decline from about 8,500 to 7,500. You guys can see back in 05, 06, we had quite a bit of sellers. Some of these were condos, not the majority, but a pretty good chunk of these were condos. A lot of these were new construction. Not all of these listings sold. So, I guess the only reason I'm saying that, kind of take that with a grain of salt. Sometimes people like to compare, just call this 9,000, versus 11,000. Well, we're still well below these levels. That's true, but perhaps we shouldn't have ever been there. This was a supply-driven bubble. And when we saw the demand go away, we know what happened with the supply. They had to chase buyers, price declines, cancellations, you name it. And so, maybe it's not apples to apples to compare to that. Maybe we should have been around 9,500, maybe 10,000. And you guys can see even before COVID, we were well below those levels. Now, obviously, even more so. Another interesting thought here that I'd like to point out is some people think this fell from the sky. And I suppose it kind of did. It was what economists call a black swan event. So that's true. However, 1, 2, 3 years, we've seen 3 Junes in a row of fewer new listings compared to the year prior. So yes, this is a more dramatic decline. Yes, this is COVID driven. However, we have not seen gains in seller activity since 2016. Interesting little thought there, if you will. Okay, over to our demand indicator, 6,800, almost 6,900. You guys can see, when's the last time we were there? No. Close, but no. Last time we were 6,900 or anywhere near there was in 04. Pending sales just hit a 16-year high. Now, let's take that with a grain of salt as well. Why? We know that folks who would have been signing contracts or who may have been signing contracts in April or May postponed that. a small share might have canceled their plans outright, but the vast majority haven't. They've simply postponed purchase activity. And so, again, take this with a grain of salt, because some of the activity that likely would have gone into April and May was sort of pent up or delayed or displaced into June. So just be aware of that. Again, let's point out, guys, we did see 2 consecutive Junes of very small declines in pendings. That has to be supply driven. That has to be inventory driven. At some point, we can't keep putting up higher sales figures if there just isn't the product, there just isn't the inventory out there, again, on which to make offers. Closed sales, still not seeing a gain here, even though we saw a nice gain in pendings. So guys, remember when we talked about that life cycle of a listing? This gain in pending sales will eventually translate to a gain in closed sales. Can't guarantee if that'll be next month, if that'll be in the July numbers or August. The other thing to keep in mind is that lenders, so the closing tables are crowded, right? Lenders are so busy doing all those refis and those initial purchase applications that, all my lender friends and our partners, at the Mortgage Bankers Association and our friends who are in the lending industry, they tell us that they are just slammed. So it's really hard to get some of these deals to the closing table, as we saw, just because of the volume. And, never mind this, don't forget about the refi volume as well. So pretty hard on our lenders and closers and title folks. All right, this is very bright, forgive me. We're looking at 2019 in blue, 2020 in red. This is existing home sales. This is national. You'll notice it looks like 5,000, but remember, this is millions. So this is 5 million sales because that's national. So you guys can see, look at 2020, trending above 2019, even March. Then we see COVID hit. We see the decline in April, even more of a decline in May, a decline in June, but less of a decline, right? It's tightening up. So I think that is a good sign. It's hard to say the worst is behind us. It is impossible to say we're out of the woods, but it does look like these declines are shrinking, and that's a good thing. So I think we're making some progress. CDOM, cumulative days on market. Sellers used to have to be pretty patient, 105 days on market, 105, down to 18, right? Down to 18 days. Remarkably low numbers, remarkably quick market times. 14 days is obviously 2 weeks. So what is this? 2 weeks and a couple days, 2 weeks and 3 or 4 days. So really fast market time versus 3 months and even 3.5 months. Now we're just barely over 2 weeks. Median sold price. June of 06 was $237,000. Back in 06, that was our median. Half of our sales were above that median. The other 50% of our sales were below that median. You guys can see we rode that wave in the Great Recession all the way down to about 160 grand. And then we've stomped higher up to about 305,000. And that was a 5% gain for June. Even though we did have a smaller gain in May, I think it was about 3.5% in May. So it looks like we're getting, closer to back on trend, +5, +7, +5, +7, +5, +5. How about some of these early days, early on in the recovery? Think of this as phase 1 of recovery. We saw an 18% increase in sold price. Obviously off of a pretty low baseline, but a pretty dramatic increase there. How about price per square foot? Why do we like this? I'll tell you guys in a second. So about 15 years ago, buyers were offering and sellers were accepting about $140 per square foot. Doesn't matter if you have 600 square feet or if you have 6,000 square feet. This was that median. Again, half above, half below, just about $140 per foot. Last month, June of this year, it was $155 per foot, and that was about 3 1/3% up. So I guess maybe one of the smaller declines since 2015, but still a gain here. So about $5 more per foot. Well, $5 per foot multiplied through by a 2,000 square foot house, you're looking at about 10 grand. Help me think about this though, guys. Let's think about this together. Home A, Home B. Home A sells for $200,000. Home B sells for 400,000. However, let's look at the size of these. Square footage, 2,000 square feet here, 4,000 square feet here. Guess what, guys? Even though our sold price, our sales price just doubled from 200,000 to 400,000, price per square foot didn't change a penny, not a dollar, not a penny. Didn't have to, because the size of the home doubled. Well, no kidding, the price is going to double when the size of the home doubles. But this is why we look at PPSF, because larger home selling, and think about this, guys, fewer smaller condos is going to skew toward bigger. More new construction in the suburbs is going to skew toward bigger. More luxury product is going to skew toward bigger. So why would we let bigger home sizes skew our insights into price or how we think about home prices? So it's not a magic bullet. It's not the end all be all, but it's a different lens through which to look at the market and through which to assess market health. So it may look like prices are rising, but if sizes are rising, maybe that speaks to there's a different product selling than, you know, we see supply and demand driven price appreciation. So I know that's a little nerdy, but, you know, just interesting to think about. Even though sizes increase, our price per square foot doesn't have to, because we divide out that price by square footage. We normalize our data by size, or adjust our data for size. All right, I spent a little bit longer than I should have on that. Forgive me. It's just so exciting, so interesting. All right, guys. June percent of original list price received at the point of sale. So this is simply that ratio of sold price to list price. Okay, first thing I notice, wow. Sellers in 2018 were getting 100.3% of their original list price. So they got 100%, they got all of their list price plus 0.3% for good measure, right? This is the competitive bidding wars. This is multiple offers where folks are outbidding each other, and yes, they are going over list price. Guys, this is for the whole Twin Cities market. It's kind of an amazing figure. You know, it's one thing to think about, I don't know if this was the North Loop or Uptown or Northeast or Highland or Mac Groveland or you know, wherever, Richfield, St. Louis Park, some of our higher demand, closer in maybe walkable areas that a lot of millennials and baby boomers, I might add, are kind of looking into. You know, it's pretty amazing. This is market wide. So we've come down a little bit to 90. We are now standing at 99.6%. Another interesting note here, that is higher than any point during the bubble, right? The 03, 04, 05. So even though we've come down a little bit from over 100%, you know, it's kind of funny that, you know, we are still well above where we were between 03 and 05 or 06. Interesting. You know, we had a little bit of a decline here. Nobody really batted an eyelid. No one really gave it a second thought. Inventory. This is the big story, guys. This is really as we discussed, this is the big factor that's impacting the market prices, market times, frustrating buyers, helping sellers get multiple offers. There just isn't enough product out there. So believe it or not, 2007, we had 37,000 properties that were listed under active status in North Star MLS. 37,000. We now have 9,700. Call it 10,000. Guys, by far the most dramatic thing that we've seen happen in the market. Again, down about, depending on the month, you know, we can be down anywhere from 66 to 75%. You know, 40, I know we're not quite at 40, or this wasn't at 40, 40,000 down to 10,000 obviously is a 75% decline. This is a little more like a 66% decline, but really dramatic here, guys. Down 25%. I actually did find some data that compares us to other data from Realtor.com, other regions. So here's Minneapolis. You can't make this up, guys. What were we, just about 26%? That's where they've got us. Minneapolis just over this 25% mark. You guys can see we're kind of in the middle, maybe towards some of the bigger losers. Miami and Vegas down only about maybe 11 and 13%. Bay Area, Seattle, Nashville, Houston. You guys can kind of see from there. I think Denver is a decent sister city. You could think of it as a sister city. Yeah, maybe Nashville, Seattle a little bit, San Fran a little bit. I'd like to see Austin, Boston, maybe Pittsburgh. What else? Yeah, maybe some of those guys. Maybe Phoenix. Maybe some of those guys. Salt Lake. How about months of supply? Month supply of inventory. So this is our absorption rate. We have always said that 5 to 6 months. 5 to 6 months is considered a balanced market. Economists call that market equilibrium or price equilibrium, where we're not a seller's market, but we're also not a buyer's market. We're kind of in the middle. We're balanced. Think of that as balanced. We once had 11 months of supply. That was a buyer's market. Buyers could walk into listings back in 2008 and say, I know you're asking 300,000, but would you take 265,000? And maybe there was a counter, but this is when buyers were really in control. Buyers were sitting in the driver's seat, holding the reins. How about now? Less than 2 months of supply. Excuse me. So 1.9 months of supply, well below our 5 to 6, or maybe even 4 to 6 range. So definitely a seller's market. Here, sellers are in the driver's seat. Sellers are holding the reins. Sellers have pricing power. Back here, buyers had pricing power. Sellers don't have to accept lowball offers because the odds are pretty high, depending on price point and area. The odds are pretty high that they've got 2, 3, 4, sometimes 5 backup offers. And sometimes some of those offers are cash. Really consistent with a seller's market. And we just saw, you guys, sellers are getting a huge share of their asking price, almost 100%. And homes are selling in near record time, 17, 18 days. So you guys can see as this goes down, market times go down as well. And as absorption rates go down, that ratio of sold to list price goes up. So I always like to kind of mention how almost all of our indicators are interrelated or, somewhat correlated in some way. I just love when things work out like that. All right. The affordability squeeze percentage of actives priced under $250,000, under 250,000, and we're using our rolling 12-month average here. We won't spend a ton of time on this, but going back to 2004, and guys, let's start with Twin Cities, although know that Minneapolis is in blue and St. Paul here is in red. So Twin Cities region, about 62% of our actives in 2004 were under 250,000. As we got into the bubble, obviously that share shrank, I think. And then as we headed into the Great Recession, we saw it rise again because we had an increase in these lower price, these more affordable listings. How about since then? We are down to under 25%. So more than two out of 3 listings in the metro, 9 years ago used to be under 250,000. Now fewer than 1 in 4 are under 250,000. Sorry guys, I think I said 200,000. Obviously, our friends in St. Paul are enjoying slightly higher levels of affordability. Looks like about 53 to 54% of listings in St. Paul, of active listings in St. Paul, are priced under 250,000. So just over half are under 250,000. That doesn't mean there aren't $2 million sales in St. Paul, but it does mean that overall this is kind of what's happening. Obviously, guys, you see, obviously Minneapolis a little bit less affordable than our friends across the river. But obviously in the Twin Cities, you see a lot of new construction in the suburbs. You also see, think of luxury markets, maybe Wayzata, Edina. What am I thinking? Maybe North Oaks. Is it North Oaks or Vadnais? I think it's North Oaks. A couple at Lilydale, I don't know, Sunfish Lake, a couple of these other areas where you have high priced activity, that aren't in the core cities. Hey, that's not to say there are multi-million-dollar sales around Lake Harriet and Lake Calhoun. So we know it's still happening, but this is still the trend, and I think it's a pretty compelling trend. I also think it's a pretty challenging trend for folks who are a little bit lower on the socioeconomic ladder. We want to have a market a housing market needs to be a spectrum, right? It needs to be a continuum. We need to have product under 250, and we need to have product over $1 million. If we don't have product over $1 million, the buyers who would be there are going to be competing with other buyers, in different price points, and they're going to outcompete them in cash any day of the week. So it's really important that we focus on this affordable segment. It is obviously the segment that is lacking, that's missing the most. So it's in really high demand and really low supply. So it's hard for builders to get under 300,000. But if we build $300,000 homes, maybe some owners of these homes would move up and then free up these more affordable properties, and kind of move up that housing chain. I know there's some scholarly literature out there about the housing chain that's pretty compelling. So shifting gears a little bit, median seller tenure in the home. How long are homeowners staying in their homes? We used to say 5 to 7 years. I hope we don't need our iPhones to tell us 6. Right in the middle of that 5 to 7 range, right? A little bit of mathematics there. So 6 years, right? Median. Half of homeowners spent more time in their homes. Half of homeowners spent less time in their homes. How about after the Great Recession, 08, 09? Wow, this shot up to 9 years as a median. 10, 9, 10, 10, 9, 10. So think of this now as 10-year tenure. 10-year tenure. Kind of rolls off the tongue nicely. You got to have some fun with this stuff, you guys. So 10 years, sellers are staying in their homes quite a while. Perhaps if we had more listings, more opportunity out there, more product, again, across the price spectrum, maybe people wouldn't feel compelled to hang on to their homes until someone pries them from their cold, dead fingers. Sorry, that was going a little far, a little bit of an overstatement. But if I own a home under 300,000, I'm really reluctant to let it go because I'm going to be really challenged to find something at a similar payment in a similar area, school district, close to my work. Although I guess not many people are going into work nowadays. But you guys can kind of see how all these factors have driven this metric higher. So pretty interesting there. Realtors are not reporting a flood to the suburbs. I know we showed this last month. So I still think this is pretty interesting. Have your clients change their neighborhood preferences due to COVID? 94% of agents said no, not at all. Search criteria is about the same. 5% said, yes, I am noticing my buyers. I'm noticing a little bit of a trend away from city centers and downtowns to the suburbs. And then 1% actually said, yes, I'm noticing a trend. My buyers are changing their search areas from suburbs into more urban areas, into core cities and downtown business districts. So, interesting thought here, 5%. It's, I know we say due to COVID, but sometimes these areas that we're searching are going to be different anyway. Think of millennials as they age out of their condos. Maybe they're getting married, they're having first, second, third kids, whatever. They need a little bit more space. And yes, even millennials are moving into the suburbs. I know we were asking whether that was going to happen about 10 years ago. And sure enough, it is. Perhaps not in the same numbers as previous generations, but we do see that happening. So some of this will have happened anyways. Oops, forgive me, you guys. That was a big no-no. Silence. Okay, so yeah, the vast majority, no change in search area. Another interesting data point here, how has COVID impacted apartment searches? So I know this is not owner occupied, but apartment searches, quarter over quarter change in the percentage searching in their same city. Red is losses, green are gainers. So we can see some losers. Looks like Chicago, LA, maybe parts of the Bay. Looks like people are moving over to Sacramento or some more affordable places. Portland and Seattle seem to be doing okay. And here in Minneapolis, we're doing okay as well. We are not seeing, this data doesn't support some of the narratives out there that there's, any sort of exodus or that, people are looking elsewhere. We're still green, we're still positive, and that's encouraging. So, just a few takeaways before we pivot. Things sure do look better, including our leading indicators, specifically showings as one of our most reliable leading indicators. I want to say again, no one can say with certainty that the worst is behind us. No one can say that we're out of the woods. So that I just want to be really clear, that is not what this means. There's still plenty of uncertainty out there, especially in the policy arena. So forget that it's an election year, although that does tend to have some impacts on consumer spending and consumer confidence. This week, some of those unemployment benefits are set to expire. So I know there's some horse trading going on between the House and the Senate, and there's some concerns about, are people going to, are the checks going to be a little bit bigger than what paychecks might have been? A lot of economists that I follow are saying, okay, sure, there should be more incentive to work than to not. That's fine. However, now our concern should be keeping us out of a worse recession or even a depression. I know a lot of folks are concerned about the debt as well. Our national debt just skyrocketed from, I think, 21 trillion to 25 or 26 trillion, probably 27 by the time this is all done. Yes. 6 trillion is a very scary number to add to our debt and to saddle future generations with. However, the debt should not be the primary concern now. It should be preventing 25% unemployment. It should be preventing, major losses of income to households and everything else that comes along with that. That should be our focus. Then we have to focus on the debt and other things. So that's not even me speaking. That's a lot of the economists that I follow. So 3, there are some market concerns still. We see sold to list price ratio having a little bit of pressure, but prices are still very likely to remain firm. 5, I think this is a big one that we talked about early on. Rates are at a record low again, about 3%. We saw 2.98% on a 30-year fixed. So depending on credit scores and FHA versus conventional and PMI and all that stuff, just know that rates have never been this low. I think that's a message that we ought to continue to get out to buyers. Demand truly is relentless. Of course, 6 is related to 5. Demand is truly relentless, and supply is very much still lacking. 7, mini recession. It's likely to be brief, and it's unlikely to impact values much. Dr. Lawrence Yun, chief economist of NAR, that's actually from his mouth, not from mine, but I want to make sure you guys hear it. Unemployment and jobless claims still high, but we are trending in the right direction. We'll see what happens when we see some July and August numbers. And so much still depends on the path or trajectory of the pandemic. All right, let's end on a funny note before I pivot over to some of our market reports and InfoSparks. This is dating in Paris. This is how they're doing dating in Paris in a nice cafe in Paris. All right, I thought that was fun. So June reports, local market updates, and all of our other wonderful reports. I want to just take a moment with you guys to kind of look into that. So let's take a peek. So first things first, right here on our homepage, I know most of you are very much familiar with this, but let me just do a refresher. A couple ways to get at some of our reports, market data right here at the top. I tend to just scroll down and click on all of our many wonderful reports here. I'll do local market updates. I like to say, hopefully this map is a familiar one or you might be in trouble. Hennepin, Anoka, Ramsey, Dakota, Scott. I'll just click on Hennepin County. Now we see all the cities within Hennepin County. What should we do today? Let's do Eden Prairie. I think I saw Carrie Lynn on earlier. Looks like she's still there. So Eden Prairie, guys, new listings down 14%, closings down 28%. So here we did see a price decline for June. How about for the last 12 months? Overall, no, up about 3 or 4%. So, June, May and June may be ugly, but overall, the last 12 months or so, obviously not as bad. 2 months of supply, 58 days on market on average. So you guys can kind of see how things look. I'll do a little trick here. Instead of Eden Prairie, let me just do Edina. All right, our friends in Edina. Very much different price points, about $600,000 as a median, $650,000 as an average. Of course, average is almost always higher because it's going to be skewed by some of these higher priced homes selling. So $600,000 in June. However, over the last 12 months, it's a little bit more like 480, 485. And a little bit more like 6.5% versus 10%. So, we just saw Eden Prairie, down, 12%, and yet we see Edina up 10. So some of these local markets are going to be a little volatile. Just know that. Because Edina is a higher price market, we see higher absorption rates 3.5 months of supply. We also see higher market times, 93 days versus 40, 50, 60 in a lot of other markets. Let's just do one more just to drive this home. What should we pick on? Maybe we'll go to Dakota. Let's do Eagan, big city. I know a popular growing city over there. So about 3.25, a little bit more affordable, obviously, up about 4% over the last year, about 305K, up about 4.5 to 5%. 1.2 months of supply here, very much a tight market, which explains why sellers are getting 100% of their list price, right? Down from 100.6% of their list price. So Eagan pretty hot. Eagan pretty hot in June, minus I guess a decline in activity, but still pretty hot overall, a pretty tight market. Okay, time check. We got 10 minutes. Let's do a little bit of InfoSparks, guys. You know what? Let me just duplicate this. And so this is what you'll see when you land there. And I guess just a refresher for those who may not know, here we are in the North Star Matrix universe. Right under this home tab, you'll see InfoSparks right there. You will also see InfoSparks right there. You will also see InfoSparks right there. So 3 places, including from the listing page. Oh, nice. What a beautiful photo. This will definitely sell that house. Come on, people, use photos. So when we click on InfoSparks, this is what we see. We see our area tab here. We can filter down to counties, neighborhoods, communities, cities, school districts, zip codes. We see our metrics down here. So we can look at, we're right now looking at sales prices, monthly. There's our 304,995 figure. We can look at days on market. There's our 18 days on market. We can look at new listings. There's our minus 12.25%, just like we saw. Inventory, there's our 9,700, down 25.6 or 25.7%, just like we saw. So, it's all the same data, but the glorious part here is that it's interactive and you guys can filter down to areas and market segments that matter to you, that matter to your buyers and sellers, or to an area you're farming or thinking about. So let's see, how should we approach this? Let's do new listings and let's do a breakout. I know there's been some chatter about this, so I do want to talk single family, condo, and townhome. So we've now broken things out, you guys. We're looking at single family, which we can turn off just by clicking on it. Condos in red, townhomes in green. You see so much seasonality here, right? A lot of sales in May, not as many in December. A lot of sales in May, June, and July, not as many in December and January. So, if I want to smooth that out, really simply, I'm just going to go with my rolling 12-month trend. Now we can really see the trend a lot more clearly. And we can even hone in on these 2 other segments. We can also really see the impact of COVID, right? This is definitely moving the needle here. It's pretty evident. What I think is interesting is look from Jan to Feb to March, you guys, we were actually seeing some increase, some positive momentum in the right direction. We really need to see more new listings. And then COVID hit and we can see the impact from there. This is a long-term trend that goes all the way back to 2005. I want to just see the bar chart for the last couple of years. New listings, single family in blue, again, condos red, townhomes green. Oops, this is 12 months. I suppose there's still interesting observations and insights here, but let's just look at June. And guys, the reason we're doing that is the last 12 months really look nothing like the last 2, especially 2, 3, 4 months. So that's why I think it is important to look at just June alone. So interesting here, guys, new listings down 15% single family, down 4% for townhomes, but up 9.5% for condos. Pretty interesting data point there. How about pendings? How about on the signed contract side? 10-11% increase in single family, a very small 1% increase in townhome, but 12% fewer contracts signed on condos. Interesting data point there. So this is Twin Cities region, but we know that Minneapolis hosts the majority of condos, at least a disproportionately high level compared to surrounding cities in the rest of the metro. So, pretty interesting data here. Let's check out market times. Yeah, a little bit of a gain. I suppose we did see the biggest gain in condos, 4 more days, 21 to 25. How about absorption rates? 2 months of supply of single family, almost 3 months of condos, and then technically our tightest townhomes, 1.7 months of supply there. So these are all sellers markets. I'd even say pretty strong sellers markets, but to varying degrees, not that much variation. I suppose condos may be the outlier, but all of these are under 3 months of supply, and 5 is considered balanced. Townhomes, a lot of demand, not a ton of supply. I know they're building some in Brooklyn Park and Blaine and elsewhere, but baby boomers really like this product. And as we see baby boomers and empty nesters, think about shrinking their households, I know they're looking at this product type, and there just isn't a lot out there. What else really quickly? Time check, 5 minutes. Let's do one more, and then we'll see if there are any questions. Let's do new construction. I know this has actually been an interesting one. So let's start with new listings.
David, sorry. We do have one question asking if there is anything like InfoSparks available in Florida, specifically the Naples area.
Oh, geez. You would have to check with your local MLS and association. We only have this through North Star, and this is only for the Twin Cities region. Let me say, though, I have a dream of a future where instead of filtering by just Minnesota cities, I would love to be able to filter by, cities and metros across the nation and zip codes across the nation. So I hope that's coming soon, but we are not there yet. But do check with your local board, because there are a lot of different MLSs and associations that offer at least these reports, at least what we call these PDF reports, right? Where it'll just kind of be the PDF. Still nice for mailers, good data for social media and elsewhere, but it won't quite be interactive like this tool is. Good question.
And then
right.
We have one more, wondering if you can speak a little bit to the condo market, because it seems to be different than the single family market.
Yeah. I mean, we kind of looked at some of that, but, I think a couple thoughts here. I think especially early on in the pandemic, I think there could have been some fear or some concern around, the shared spaces and close proximity when it comes to condos. Not all that different than higher density rental buildings. So it's not necessarily just on the owner occupied side. It's also on the renter occupied side. And that makes sense, you guys. The way I would talk about it is, I think the condo market is experiencing a disruption. But let me also say, I have read reports, sort of absurd reports, and the headline was, "Is the condo market dead?" And I just thought that went really too far. No, the condo market's not dead. And in fact, it's kind of interesting. I think most buyers would want to see new listings. And for every seller, of a condo in Minneapolis, there's usually 2 or 3 buyers competing with one another. So, I don't see the condo market unraveling, but I could see a temporary disruption. So yeah, I mean, it is really interesting to look at, when you think about sales activity, seller activity, as we saw, and then how about percentage of original? So single family flat at 100%, townhomes flat at 100%, condos seeing a little bit of pressure, 1% pressure from 100% down to about 99%. So you guys, it's not a big change, but it is a change. You know what? I'm actually glad, who is that? I'm glad Kim asked that question, because let's look at this a different way. Let me go to my trend line. Let me go to my maximum time frame. And here, again, guys, all this seasonality, I don't want to see that. So I'm going to go to my rolling 12 month view. We'll give our server just a second to think. And this is a pretty interesting trend. Some people thought, any changes in the condo market must be due to COVID. They must be attributable to COVID. Well, interesting. So condos back in May of last year, look at this. We went from 99.5 in July of last year down to 99.4 in August, down to 99.3 in January of this year, pre-COVID, down 99.2 into March. I suppose the second half of March was COVID, and then down to 99. So what I think is interesting is people think that any changes in the condo market must be the result of COVID and maybe related health concerns. And what we actually see is, we saw some signs of weakness in the condo market pretty much exactly a year ago, 1 year ago, to the day or to the month maybe. So, while I think some of the changes in seller activity and buyer activity, are notable or different, distinct for condos compared to other property types, we have been seeing weakness for some time. So just keep that in mind. What else? Anyone else have any thoughts or comments? I know we're right about at 10.
Those are the only two that I've seen come through at this point. Oh.
Okay. Thanks, Lisa. We try to keep it fun. After all, it is data. You got to have some fun with it. All right. Well, with that, I should say thank you again for joining us today on this month's COVID-19 market update. I want to say thank you again to all of our wonderful sponsors, Bell Bank Mortgage, North Star MLS, Royal Credit Union, and Supra. I want to also mention a recording of the webinar will be available on our COVID-19 resource page. Just head over to mplsrealtor.com. As always, I encourage you to join us next time for more fun with numbers, and we'll go on another data adventure. As you guys know, registration is required, and the link is right on our homepage. Again, mplsrealtor.com. Thank you again, and have a wonderful day.